Welcome, everyone. My name is Gary Coleshill, and thank you for attending this educational seminar, The Role of Annuities in Retirement, to help you understand how annuities can have a positive impact on your retirement. I'm a licensed insurance agent in the state of Arizona and specialize in annuities. Now, we are hopeful that you will benefit from our time today. So let's get going. Firstly, I'm going to start out with a few disclosures. Now, I'm not affiliated with or endorsed by the IRS or any government agency. This presentation is not intended and should not be construed as tax advice. I'm a financial planner with a desire to help people better understand taxes in retirement. The information we'll cover represents our current understanding of income taxes in general and should not be considered legal or tax advice by consumers. Please consult with an enrolled agent, CPA, or attorney before implementing any of the strategies disclosed wherein. Now, here's a preview of our main topics today. We'll open up with a discussion on today's retirement landscape and see how retirement has changed from previous generations. We'll then take a look at the key risks in retirement that could threaten your financial security. And then take a look at the different types of annuities and see why annuities are gaining in popularity. Now, you may have heard of the old three-legged stool approach to retirement income. In the past, retirees could rely on Social Security, a company pension, and personal savings to fund their retirement. But people retiring today and in the coming years have fewer sources of guaranteed income as employer funded pensions have given way to 401k plans, and Social Security by itself is simply not enough for most people. To address these concerns and meet the challenges of today's retirement reality, the insurance industry offers a unique solution to that problem: the annuity. Now, forms of personal retirement assets may include employer plans such as the 401k plans and 403b accounts, or may include individual retirement plans such as traditional IRAs or Roth IRAs, and may even include bank accounts, investment accounts, annuities, or cash value life insurance. With the increased personal responsibility and importance of personal savings, many people retiring today don't have one retirement nest egg, but have a basket with many eggs in different accounts, such as 401k, an IRA, a Roth account, or even non qualified accounts. The question then becomes, how do I crack my retirement nest eggs in order to fill the income gap during retirement? So what is the income gap? The income gap is represented here, and it's the gap between your pension or social security income and your desired retirement lifestyle income. Now, the income needed to fill your income gap often comes from withdrawals or distributions from your personal retirement savings. Annuities can be a great solution to fill this income gap, providing retirees with peace of mind with guaranteed lifetime income. So, time for audience participation. What do you think are some ways to fill the income gap? Please tell us what you think. Raise your hand and I can unmute you. Okay, thank you for all your responses there. And yes, you are right. You've all come up with several of these ideas here. The most common ways to fill the income gap may include continued working, tapping into savings, taking required minimum distributions from qualified accounts, and you could liquidate assets or positions, or you could purchase a commercial annuity. Now, there are only three sources of guaranteed lifelong income that you cannot outlive. They are firstly, Social Security, secondly, an employer pension, and a commercial annuity. Now, Social Security is the major source of income for many retirees and is often their only source of guaranteed inflation adjusted retirement income. But by itself, Social Security often doesn't provide a meaningful amount of secure income. The average monthly benefit for a retired worker is $1,355, and the average monthly spousal benefit is $705. And less employees today are offering pensions as a retirement benefit. Therefore, individual annuities from insurance companies are playing a more integral part in providing predictable income and a secure retirement. Now, purchasing a commercial annuity with a portion of your personal savings can add another layer of guaranteed lifelong income. In this example, we purchased an annuity to provide an extra $15,000 of annual income. As you can see, the income gap is much smaller. And a common question among retirees is how much guaranteed income should I have? A general rule of thumb is to have enough guaranteed income to cover your basic or essential household expenses, which may include food, housing, transportation, healthcare, clothing, personal items, and taxes. And this provides a solid foundation during your retirement years. The money needed to pay for these lifestyle expenses on the right hand column can be paid from personal savings. We're also seeing more efforts from industry groups to get the word out and educate consumers of the benefits of annuities in retirement. Here's a great quote from Dr. Michael Fink from the Alliance for Lifetime Income. We are facing the first generation of American workers approaching retirement with no clear idea of how much money they can count on receiving or what they can safely spend from their savings, such as IRAs and 401k accounts, without running out of money. Now, good planning starts with having a realistic expectation of life expectancy. Now, longevity is the risk of living a long life. Longevity magnifies the impact of the other risks and can result in outliving one's money, which is a top concern for many seniors. Life expectancies for seniors have never been longer, and one's mortality is largely unknown. Now, here's a graphic that demonstrates the average life expectancy. It's very important to note that half of the people live beyond life expectancy. Therefore, it may be prudent to plan for a long life, one that may extend well beyond average life expectancy, which is a reality for many retirees. So, how long will you live? Longevity is a key factor in a social security decision. Unfortunately, many people underestimate how long they may live. With advances in health and science, many people are living longer. And as a result, there's a very good possibility that your retirement might last 20 or 30 years or even longer. So here's a chart that shows what a person's life expectancy would be if they're alive at 65. A male living at 65 has a 50% chance of living to age 87 and a 25% chance of living to 93. A female living at age 65 has a 50% chance of living to 89 and a 25% chance of living to 96. And for married couples, there's a 50% chance uh, one spouse will live on to be age 93. Inflation is a hidden risk and a critical factor when planning for retirement. It will have a considerable impact on your budget, your lifestyle, and your overall planning. Now, inflation is the general rise in the price of goods and services over time, which can be very damaging to seniors on a fixed income. Over time, the long term impact of inflation can be devastating and can threaten your ability to maintain your desired standard of living. It reduces your purchasing power, erodes the value of your portfolio, and drives up the need for a higher retirement income. If inflation increases during retirement, retirees on fixed incomes will have a hard time maintaining their standard of living. And inflation may not be noticeable in the short term, but it can have a very significant impact over a lengthy retirement. Even at a modest 3% rate of inflation, the cost of goods and services can double within 25 years. Here's a chart that shows the spending power of a $500,000 portfolio with just 3% inflation and no withdrawals. And as you can see, the portfolio gets reduced to $238,805 in 25 years. But even then, it is possible that over a long retirement, you may be exposed to periods of high inflation. Now, market volatility is the variability and uncertainty of market returns and is a significant risk for retirees who rely on their retirement savings for income. The ups and downs of the capital market pose a real threat for those who rely on their retirement savings for income. Market downturns put additional pressure on the retirement portfolio. The time just before and just after retirement are when people are the most vulnerable. If you have the misfortune of retiring to a flat or down market, the results could be devastating, and it's called the sequence of returns risk. Now, here's an example that shows the impact of the sequence of returns during the distribution phase. This chart shows the historical index returns of the S&P 500 from 1989 through 2008 and demonstrates the impact of the order of returns on portfolio performance, especially when losses occur early on in retirement. Now, the starting principal is $500,000. The income is 4% the first year, principal plus inflation. Now, the inflation rate is 3.5%, and the annual returns are the actual returns of the S&P 500 from 1989 to 2008. Both Portfolio A and Portfolio B have the same starting value, which is $500,000. Take the amount of inflation adjusted income and get the same average return over a two-year period, 8.43%. The only difference is that the order of returns is reversed. In Portfolio A, we see a first year return of 31.69%, while Portfolio B starts off negatively with a first year return of 37%. As a result, Portfolio A soars to 2.7 million at one point and actually ends up at 1.7 million, while portfolio B ends up at $363,365 at the end of 20 years. So taking the exact same returns and simply changing the order results in a difference of 1.3 million. Sequence of returns is real and you need to be aware of it. So what is an annuity? An annuity is simply a contract between you and an insurance company. Depending on the type of annuity, they can offer many valuable benefits for those in retirement. They offer lifetime income, protection of savings, a guaranteed interest rate for fixed annuities, the growth potential of index annuities, tax deferral, access to money, nursing home benefits, and death benefits for those who are legacy minded. Now, there are many types of annuities, so it's very important to choose the right annuity for your situation. There are income annuities, which can be either immediate or deferred, fixed annuities, sometimes called MIGAs, fixed index annuities, FIAs, and variable annuities. For the most part, variable annuities will be out of the scope of our discussion today, but variable annuities provide a variety of sub-accounts for the annuity owner to choose based on their financial objectives and their risk tolerance. Now, this graphic lines up the types of annuities based on risk. On the low end of the risk spectrum are income and fixed annuities. These annuities offer a lot of guarantees from the insurance company, and as we move right, the level of risk increases, but so does the opportunity for higher returns. For instance, insurance companies assume the investment risk on income and fixed annuities to provide the guarantees. However, the annuity owner assumes the risk with variable annuities based on the performance of the underlying sub-accounts. Now, let's take a look at income annuities. Income annuities can start immediately or at some point in the future. An immediate fixed annuity is designed to generate an income stream within 13 months after it's actually purchased. Now, the income annuity is one of the original annuities in the industry. Income annuity owners receive a regular recurring paycheck from an insurance company in exchange for a lump sum of money. Now, the insurance company manages both the investment and the mortality risk, providing stable pension like income for life or a specified period of time. Typically to people in or just nearing retirement. The premium is held in the insurance company's general account, which is comprised mostly of corporate and government bonds. Income annuities funded with a single premium, SPIAs, are often combined with other guaranteed income sources such as Social Security or a pension to provide an income floor to cover a retiree's basic needs. Now, income annuities offer guaranteed income, steady, reliable income, the peace of mind of not outliving your money, as well as customization and convenience. Now, types of deferred annuities. Let's compare the three types of deferred annuities using these graphs. Now, fixed annuities offer a guaranteed interest rate declared by the insurance company, but have fairly low returns. Fixed annuities are more stable and potentially safer than other ones that are tied to the market. Now, the returns of variable annuities are directly tied to market-based sub-accounts, which do offer indeed the potential of higher returns. But these returns are subject to market volatility and could lose value. You fully participate in both the highs and lows of the market. Now, FIAs, fixed income annuities, have the potential to guarantee interest based on the performance of a selected market index and are between fixed and variable annuities in terms of risk and return. But they do offer greater growth potential than traditional fixed annuities with less volatility than variable annuities. Now let's move on to fixed deferred annuities, often called MYGAs, which stands for multi-year guaranteed annuity. Now, designed for safety, fixed annuities are a good fit for retirees seeking tax deferral and a guaranteed fixed rate of interest, regardless of market volatility. Now, a deferred annuity can help you to accumulate assets more tax efficiently, and when the time is right, convert them into income that you can't outlive. With fixed annuities, the insurance company declares an interest rate in advance of how much interest will be paid. Now, fixed annuities offer a straightforward, traditional design. They help people save and grow their money on a tax deferred basis. Considered to be low risk, fixed annuities bring predictable outcomes by earning a stated period of interest. They can also be structured to provide guaranteed income. A multi-year guaranteed annuity is a MYGA is a type of fixed annuity. MYGAs guarantee a fixed interest rate for a specified time period. That's usually 1 to 10 years. They're intended for longer time horizons and are often subject to surrender charges. However, many carriers offer penalty-free withdrawal provisions. The insurance company takes on the investment risk, and the premium is held in the insurance company's general account, which is comprised mainly of corporate and government bonds. Now, annuities are tax deferred, which means the taxes on the interest are postponed and not due until the money is withdrawn. Now, this leaves more money in the annuity to grow and compound, which over time can be a tremendous benefit for the annuity owner. This graphic here shows the triple compounding that is a result of tax deferral. Triple compounding allows annuities to accumulate interest on your principal, interest on your interest, and interest on the money you'd normally pay in taxes. Now, let's move on to fixed annuities, sometimes called FIAs. Now, fixed interest annuities are unique risk management vehicles that combine the growth potential of index-linked interest, protection from market downturns, tax-deferred growth, and the guarantees of lifetime income. So what is index-linked interest? With a fixed index annuity, the interest that is earned and credited to your annuity is based on the movement of a market index. If the index goes up during the segment period, a formula will be applied by the life insurance company to determine what amount of that gain will be corrected. Examples of FIA indices include the S&P 500, the Dow Jones, NASDAQ, The Russell 2000 bonds and proprietary indices developed by insurance companies. Now, even though the underlying index may increase or decrease in value, fears have a guaranteed floor, usually 0%, protecting the contract owner against a loss if the index decreases in value. If the index goes down, no interest is earned, but the value of the annuity contract does not go down. So typically, any interest that's earned and credited to the value of the annuity is locked and cannot be lost as a result of future corrections in the index. Now, carriers use a few common approaches to calculate how much of the index-linked returns get credited to the contract as interest. Now, we have what we call a cap, and that is the maximum interest rate that could be earned during the crediting period. If the underlying index exceeds the cap rate becomes the credited rate. Next, we have the spread, which is also called the margin, the percentage that is deducted from the index return at the end of the crediting period. For example, if the annuity has a 4% spread and the index increased by 10% over the crediting period, the contract would receive a 6% interest credit. Next, we have the participation rate. The percentage of the index increase are used to determine the index-linked interest. For example, if the contract has a 70% par rate and the index increased 10% over the crediting period, the contract would receive 7% of credited interest. Now, the index cap, spread, and participation rate will always be declared and guaranteed over the crediting period, but may be changed at the discretion of the insurance company at the start of the next crediting period. So bear that in mind. Now, once the interest is earned and credited, the value of the contract cannot decline, even if the index returns are negative. The ending value of the index becomes the starting value of the index at the beginning of the next crediting period. Any previous gains are safe. Fear contract owners don't have to regain their losses to get positive crediting during the next measurement period. This helps to protect the annuity value and smooth out any market volatility. Now, here are some good questions to determine if annuities are right for you. Are you looking for balance during retirement? Are you looking for safe money options for your retirement savings? Are you looking for more guaranteed income beyond social security? And do you want growth potential without the risk of market loss? How and when will I need the money in the annuity? In addition, features and benefits may vary by product and state. Annuities are products of insurance companies and are not guaranteed by any bank or insured by the FDIC. Guarantees are based on the financial strength and claims paying ability of the underlying insurance company. If you would like, I would certainly welcome the opportunity to sit down and review your retirement income plan with you. So, are there any questions? No, don't seem to be. All right. Well, thank you very much. And if you would like to contact me, my number here is 888-894-2929. Again, that's 888-894-2929.